Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today, we're looking at CoreWeave.
If you find our talks useful, please consider subscribe, like, and comment underneath our video.
And before we really get into today's stock, we want to mention a useful chart tool for you investors and traders out there.
Yeah, definitely worth checking out.
Right. So if you want help reading trading charts a bit more clearly, you can check out VIP Algos through the link below in the description.
Which is super helpful for visual setups.
Exactly. VIP Algos is basically a TradingView indicator suite. It shows you visual buy and sell chart alerts, trend direction tools, support and resistance zones, and even take profit and stop loss planning areas.
And it works across a bunch of markets, right?
Yeah, totally. Stocks, Forex, crypto, gold, indices, futures, all of that. But just remember, VIP Algos is an educational chart analysis tool only. It's not financial advice, it doesn't place trades for you, and, it doesn't guarantee profits.
Right. Trading always involves risk.
Exactly. So always manage your risk and do your own research. And just a heads up, this is an affiliate link, so we might earn a commission if you use it at no extra cost to you.
Awesome. So let's set up the situation here, because this is one you simply cannot ignore right now.
No, you really can't.
Right. Imagine a company burning through nearly $26 billion in a single year.
It's just a staggering number.
It is. By all traditional metrics, that kind of cash burn should cause total panic. But instead, Wall Street is practically throwing a parade for them.
Yeah, they really are.
We are talking about CoreWeave, a company that is essentially acting as the plumbing for the entire artificial intelligence revolution.
That's a good way to put it.
And over the last few days, we've seen the stock surge anywhere from like 9 to 12%, finally breaking above that psychologically critical $100 mark.
Which is a massive technical level.
Yeah, and the massive news driving this explosion, their upcoming official inclusion in the Nasdaq-100 index.
Huge catalyst.
So our mission today is to unpack the mechanics of this explosive growth. We're going to look at their staggering revenue numbers, but we also really need to dissect the massive, almost unprecedented mountain of debt they are carrying to fund it all.
Right. The debt is the elephant in the room.
Exactly. And ultimately, we want to figure out if this momentum is sustainable or if it's just a house of cards.
It really is a fascinating setup to analyze for you guys listening. You have a company that is right at the epicenter of arguably the most capital-intensive technology build-out in human history.
Right.
So to understand if this is just a flash in the pan or a foundational shift in how tech operates, you have to look at how it fits into a broader investment strategy.
All right, let's move into the wealth building context.
When you look at the broader landscape, CoreWeave is positioning itself as a pure play on the AI infrastructure supercycle.
Okay, pure play.
Yeah. They are essentially a hyper-growth vehicle designed to capture the raw, insatiable demand for computing power. For a long-term portfolio perspective, this represents a structural play. The thesis here isn't just about a single software product catching on with consumers.
Right, it's bigger than that.
Much bigger.
Yeah.
It's about the foundational reality that every single major tech company in the world is currently racing to build out artificial intelligence capabilities.
And they absolutely need the hardware.
Exactly. They need high-performance GPU infrastructure to do it, and CoreWeave simply rents out that exact specialized infrastructure.
Okay, let's unpack this for a second, because I hear the phrase pure play infrastructure, and my mind immediately goes to the classic gold rush analogy. Don't mine for the gold, sell the pickaxes.
Classic tech analogy, yeah.
Right, but honestly, that feels way too simplistic here. I mean, this isn't just selling pickaxes.
Oh, not at all.
This is more like building a multi-billion-dollar intercontinental railroad funded almost entirely by credit cards.
That's pretty accurate, actually.
And you are essentially praying the trains don't suddenly learn how to fly before you pay the whole thing off.
Yeah.
So for you, the listener trying to build wealth, is this actually a foundational portfolio holding, or is this just a high-risk, speculative play driven entirely by the current AI hype cycle?
That is exactly the right framework to use, and the distinction is crucial.
Yeah.
If you are a conservative investor, like someone looking for steady dividends and bulletproof balance sheets, this stock is likely going to make you very uncomfortable.
Oh, absolutely.
This is a play for an investor with an appetite for extremely high capital expenditure business models. You are essentially betting that the massive upfront cost of building these specialized data centers will be justified.
Justified by the contracts, right?
Exactly. Justified by long-term, locked-in rental contracts from the biggest tech giants in the world. So it fits squarely into an aggressive growth strategy.
Meaning you need a strong stomach.
Yeah, it requires a real stomach for volatility. They are betting the farm that demand won't dry up. But to see if that bet is paying off, we have to look at the actual cash flowing through the door.
That gives us the bigger picture. Now let's look at the fundamentals.
And this is where the numbers get almost dizzying. On the top line, the revenue growth is just exponential.
It's crazy.
In the first quarter of 2026, CoreWeave's revenue more than doubled year over year to $2.078 billion.
Wow. $2 billion in a quarter.
But that's just the starting line. Management is guiding for $12 to $13 billion for the full year 2026.
Wait, really?
Yeah. That implies roughly 3 times the growth compared to 2025.
We have to pause and contextualize that for you guys listening. Tripling your revenue when you are at the $10 billion scale is practically unheard of.
It really is rare.
That is like trying to maneuver a massive aircraft carrier with the agility of a jet ski. How are they pulling that off when they have massive competitors like Amazon Web Services and Google Cloud?
They are doing it through a very specific competitive moat. They have what is called a first-to-deploy advantage.
Okay, meaning they get there first.
Right. Because they are a pure play, meaning this is literally all they do, without legacy enterprise cloud systems slowing them down, they are incredibly agile.
Makes sense.
For instance, they recently completed the industry's first bring-up and validation of NVIDIA's new Vera Rubin NVL72 platform.
Before AWS or Google.
Yep. They beat all their massive legacy rivals to it. If you are a hyperscale client and you need the absolute most advanced compute right this second to train your new AI model, you don't wait for AWS to integrate it next quarter.
Right. You go to whoever has it online now.
You go to the company that actually has it running today. And to validate that strategy, NVIDIA themselves took an 11% stake in CoreWeave.
Which is massive.
It was a $2 billion investment, and NVIDIA officially named them an exemplar cloud.
Okay, that is an incredibly rosy picture of the top line. And, having NVIDIA as a backer is huge. But I am looking at the bottom line, and I really have to push back here.
Fair enough. Let's hear it.
The cash burn is frankly terrifying. To put $26 billion in cash burn into perspective, that is roughly the entire annual gross domestic product of a country like Iceland.
A lot of money.
Gone in 12 months. In Q1 alone, they posted a $740 million GAAP net loss. How do you reconcile that? I mean, you can't just grow top-line revenue forever if the floor is falling out from beneath you.
It looks catastrophic on the surface, absolutely. But we have to separate cash operations from accounting rules here. Those massive GAAP losses are largely driven by non-cash depreciation.
Okay, can you break that down for the listener? What does non-cash depreciation actually mean in plain English?
Sure. Think of it like buying a rental property. When you buy a house to rent out, accounting rules let you claim that the house is losing value, depreciating every single year.
Right, for taxes.
Exactly, which lowers your taxable income on paper. It looks like a loss. But in reality, you aren't writing a check for that depreciation. The physical cash from the rent is still hitting your bank account every month.
Ah, I see.
So CoreWeave is building billions of dollars worth of servers, and GAAP accounting forces them to aggressively depreciate that hardware on their income statement.
So it looks like a massive loss.
But if you look at adjusted EBITDA, which strips out those non-cash paper losses to show the actual cash generated by the business operations, they actually posted a very strong $1.16 billion profit in Q1.
Okay, so the core business of renting out the servers is actually highly profitable on a day-to-day cash-in-hand basis.
Very much so.
It's just the aggressive accounting of their scaling that makes the net income look so terrible.
Precisely. And to secure that future cash flow, they've built up a $99.4 billion revenue backlog.
Wait, $99 billion?
Almost $100 billion, yeah. That includes a $21 billion contractual commitment just from Meta alone. So that backlog is the safety net that gives them the visibility to keep spending and building so aggressively.
That gives us the business picture. Now let's move to the catalyst timeline.
So we are entering a very tight window of major market-moving events over the next 3 months. First, on June 22nd, we have the official inclusion into the Nasdaq-100 index.
Yeah.
Then, just days later, on June 27th, they will be included in the Russell 3000 index.
Back-to-back index buying.
Yep. And after those index events, we look toward August 11th for their Q2 earnings report. In that earnings call, the market is going to be laser-focused on any updates regarding their new agentic AI stack.
Stop right there. Agentic AI stack sounds like pure Silicon Valley jargon.
A little bit, yeah.
What is that, and why does it matter for the stock price?
It's actually a game changer for their profit margins. Right now, most AI is conversational. You ask a chatbot a question, it gives you an answer.
Right, like ChatGPT.
Exactly. Agentic AI refers to artificial intelligence that acts as an independent agent. You give it a goal, and it goes out and completes a multi-step task on its own.
Oh, wow.
Like booking flights, writing and executing code, or even managing a marketing campaign without human supervision. CoreWeave is transitioning from just renting out the raw hardware to offering the full software platform required to run these independent AI agents.
And software means better margins.
Exactly. Selling software services commands a much higher profit margin than just renting out physical servers.
Got it. So it's the shift from being the landlord to being the premium concierge service.
That's a great way to frame it.
But wait, I'd ask a critical timing question for everyone listening regarding those index inclusions. The dates, June 22nd and June 27th, are completely public knowledge.
Yes, they are.
Every institutional algorithm and trader on Wall Street knows this is happening.
Yeah.
So isn't this mechanical buying wave already completely priced into the stock? Why would anyone expect a further catalyst if the news is already out?
It is a totally valid point, and efficient market theory says it should be priced in. However, the mechanics of passive index funds create structural inefficiencies.
Okay, how so?
When a stock is added to the Nasdaq-100, every single passive ETF that tracks that index is legally bound by their prospectus to buy shares of CoreWeave to match its new weighting in the index.
They don't have a choice.
Right. They cannot choose to buy it early based on a rumor, and they cannot refuse to buy it if they think it's overvalued. They are forced to buy massive blocks of shares on those specific dates.
So they just have to hit buy.
Exactly. This sheer mechanical volume often creates a near-term floor under the price, absorbing any normal selling pressure.
And what about the macro environment? If they have this mountain of debt, aren't they entirely at the mercy of the Federal Reserve? I mean, if Jerome Powell doesn't cut rates, doesn't this whole operation start to suffocate under the interest payments?
They are highly sensitive to it, yes. Their cost of capital right now is enormous. Any signs of the Federal Reserve actually cutting interest rates would act as a massive secondary catalyst.
Because it makes the debt cheaper.
Right. Lower rates mean cheaper borrowing, which drastically improves their future profitability models and gives them breathing room on that debt. Knowing how all these catalysts interact with price levels is why visual confirmation on a chart becomes so critical.
Catalysts tell us what could change the story. Now let's pivot to the chart.
Looking at the price structure, the technicals are reflecting that fundamental strength and catalyst anticipation we just discussed.
It's been on a tear.
We have seen a clear, bullish breakout above that $100 psychological barrier. Right now, the stock is testing key resistance near $100.50.
And if we see a pullback?
If the broader market pulls back, the established support level is sitting right around $95.
And what about the broader trend? Because short-term pops on news are one thing, but for someone listening who is looking at this as a wealth-building asset, we want to see macro trend confirmation.
The longer-term picture is stabilizing in a very bullish way. Back in May, the chart formed what is known as a golden cross.
Okay, a golden cross.
Yeah, that happens when the 50-day moving average crosses above the 200-day moving average.
Let's translate that for the listener, because golden cross sounds like a magic spell. Why does the crossing of two arbitrary moving averages actually matter in the real world?
It matters because of institutional psychology and algorithmic programming. It's not magic, it's a trigger.
Like a green light.
Exactly.
Wow.
Many large quantitative funds and institutional trading algorithms have strict risk management rules programmed into them. They are simply not allowed to take heavy, long-term positions in an asset unless the 50-day moving average is above the 200-day.
Oh, really? I didn't know it was that rigid.
It is. So when that cross happens, it flips a switch that gives those massive funds the green light to start accumulating shares. It signals a shift from a short-term bounce into a macro uptrend.
And when you combine that algorithmic green light with the impending structural shift in volume we just talked about, those passive ETFs being forced to buy, You get a recipe for some serious sustained price action. And this is exactly why. For anyone actively looking at their positions, having a clean visual workflow is so important. When you have highly volatile, high-volume events like an index inclusion, the price is going to swing wildly.
It's going to be choppy.
Yeah, it's incredibly easy to look at a red candle and mistake standard daily volatility for a structural breakdown. You really need to be able to clearly identify where those support and resistance zones are so you don't get shaken out of a good position.
Exactly right. Knowing the difference between a normal, healthy pullback to a support zone and a true breakdown of the trend is what separates reacting emotionally from executing a logical plan.
So the chart gives us price structure. But what does market sentiment look like?
If you look at Wall Street, the narrative is overwhelmingly bullish right now. We currently have 46 different analysts covering the stock.
That's a lot of coverage.
It is, and their average price target sits at $140.28. From current trading levels, that implies roughly 40 to 50% upside.
Having 46 analysts agree on a target that high is a massive consensus for a company this size.
It really is, and the institutional money is following that consensus. In Q1 alone, 505 institutional investors added shares to their portfolios.
Wow, over 500.
Yep. Plus, you have high-profile, retail-facing voices like Jim Cramer going on air and calling the index inclusion a big deal. Furthermore, there is an unconfirmed but very persistent rumor circulating in financial circles.
What's the rumor?
That CoreWeave might tap international debt markets to refinance their older European junk bonds. If they can pull that off and secure more favorable terms, it would drastically lower their interest expenses overnight.
Okay, I have to jump in here and flag a massive, glaring contradiction for you, the listener.
All right, what is it?
If the story is this incredibly bullish, 46 analysts saying buy, 505 institutions piling in, NVIDIA taking a massive stake, why have the founders liquidated $2.3 billion in stock since their IPO?
Ah, right, the insider selling.
Exactly. If you're looking at this stock and you see the founders cashing out enough money to literally buy a small island nation, it's incredibly hard not to hit the panic button. Does this kind of aggressive insider selling hint that the founders know we are at a market top? Or is there another rational explanation?
It is the ultimate yellow flag, and it is completely rational to feel a sense of panic when you see that number. When founders sell billions, you absolutely have to ask why.
Right, doesn't look great.
But the bullish counterargument, and the one Wall Street is currently accepting, is that this is simply standard post-IPO profit-taking.
Just cashing out a bit.
Yeah. You have to remember, these founders have likely had their entire net worth tied up in this single, highly illiquid asset for years. Lockup expirations allow them to finally diversify their personal wealth so they aren't entirely exposed to one company.
So they're just taking some chips off the table.
Exactly. And you have to balance their selling against who is buying. NVIDIA, the ultimate industry insider, the company that literally invented the chips CoreWeave relies on, bought $2 billion worth of share in the exact same quarter.
So they practically offset each other.
Pretty much. It is a genuine tug-of-war in sentiment, but right now, the volume of institutional buying currently outweighs the insider selling. That sentiment picture is useful, but we still need to talk about the risks.
And the risks here are not subtle. We really need to talk about the debt avalanche. The entire bear case for CoreWeave is centered on its highly leveraged balance sheet. Depending on how you consolidate their filings, they have up to $81 billion in total liabilities.
$81 billion. Just let that number sink in.
It's massive. And the metric that really highlights the danger is their current ratio, which sits at just 0.3.
Let's translate the severity of a 0.3 current ratio for the listener. It means that if CoreWeave suddenly had to pay off all of their short-term bills due this year, they only have 30 cents in liquid assets for every dollar they owe.
So zero margin for error.
They are operating on an incredibly tight wire. In Q1 alone, they paid $536 million just in interest expenses.
Ouch.
And the new bonds they recently issued to raise cash. Those carry steep coupons, 9.625% for the US dollar bonds.
That is painful.
Nearly 10% of that borrowed money is evaporating to interest right out of the gate. They're borrowing a staggering amount of money, and it is not cheap.
This is exactly where the execution risk comes into play, and it's something you really have to weigh before adding this to a portfolio. CoreWeave is currently priced for absolute perfection.
It really is.
If artificial intelligence demand softens even slightly, or more importantly, if the hyperscalers like Amazon, Google, and Microsoft decide to accelerate building their own specialized compute instead of renting from CoreWeave, the music stops.
It stops completely.
And if the music stops, that mountain of high-interest debt could absolutely crush the company. High leverage is a double-edged sword. It amplifies your gains during an infrastructure boom, but it guarantees catastrophic losses if the revenue engine stutters.
That is the absolute core of the bear thesis.
Yeah.
If the revenue stalls, CoreWeave has very few chairs to sit on financially. Their entire safety net is that $99.4 billion revenue backlog.
That's the only thing keeping them afloat.
Right. If those long-term contracts hold up, the debt is serviceable and they will eventually outgrow it. But if clients start trying to break contracts because AI monetization isn't happening fast enough, the math on that debt gets very ugly very fast.
So with everything on the table, what's the final verdict?
Looking at the totality of the research, the explosive top-line growth, the NVIDIA moat, weighed against the extreme debt leverage, the final verdict comes in with an 8 out of 10 bullish score.
Okay, an 8 out of 10.
Yeah. For those looking long-term, this is often viewed as a multi-year hold. The goal there is to capture the massive infrastructure scale out there planning as they target 8 gigawatts of capacity by 2030.
And for the shorter term?
In the short term, there's a clear swing trade setup heading into the Q2 earnings to try and capture the momentum and forced flows from the ETF index inclusions. But it absolutely must be stated, given the severe debt profile and the inherent volatility of the emerging AI sector, this is absolutely not financial advice.
Of course.
You have to be careful.
Approaching this stock requires careful position sizing and strict risk management.
And if you want a cleaner way to read trading charts to help manage that risk, check out VIP Algos through the link below in the description. VIP Algos is a TradingView indicator suite with visual buy and sell alerts, trend direction tools, support and resistance zones, and TPSL planning areas.
Super helpful tools.
They really are. It can help make charts easier to scan across markets, but remember, it is still only an educational chart analysis tool. It is not financial advice, it does not place trades for you, and it does not guarantee results. Trading involves risk, so always do your own research and manage your risk. This is an affiliate link, and we may earn a commission at no extra cost to you. And if this analysis helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua.
Before we go, I want to leave you with one final thought to mull over. We talked heavily about NVIDIA handpicking CoreWeave as an exemplar cloud and taking that massive $2 billion ownership stake.
Right.
You have to ask yourself, are we witnessing the birth of a closed-loop monopoly here, where the undisputed king of hardware effectively uses its power and its capital to crown the infrastructure winner, leaving legacy cloud providers permanently locked out of the highest tier of AI compute?
That's a deep question.
It is a fascinating and perhaps slightly terrifying possibility for the future of the internet. Think about it.